Joe, I'll go to you first just because you're sitting to my right here. Your read in on the data that just crossed on the employment situation.
The Fed's going to hike its policy rate by 25 basis points when it meets in May. I think that's the primary takeaway. Look, a 3.5% unemployment rate, pretty much status quo, a strong, albeit cooling job market. This is what you want to see, but it's necessary but not sufficient for the Fed to actually declare, hey, a peak. Wages, what we were at 4.2 on a year ago basis, 0.3. I want to dig in a little deeper. I think we're going to have a 3 handle on a 3-month average annualized pace. That gives you a sense, I think, of where, one, the risk of a wage price spiral is. That means it's diminished. That's actually good. That means we will get a near-term top in that policy rate peak. But look, demand's still stout for workers. We're short workers in all kinds of, service industries. So we have a tight labor market. Inflation's cooling, but not cooling fast enough.
Emily, what do you think? Do you agree the print coming in slightly above expectations? Unemployment, 3.5%, really pointing to the fact that the labor market remains very tight.
Yeah, Sean, absolutely. The U.S. labor market is undoubtedly the strongest pillar of the U.S. economy today. And in fact, we just beat expectations in the non-farm payrolls report for 12 months in a row. And that's a streak that dates all the way back to 2000. So no doubt about it. And we are seeing the bond market reprice expectations, as Joe mentioned, for what the Fed's going to do in May. We were looking at about a 50-50 chance of another 25 basis point rate hike versus a hold in May. And now I'm looking at the bond market expectations, and 25 basis points is now the base case. I'm looking at the 2-year Treasury yield this morning. We're up about 12 basis points. Another reflection that the Fed still has some work to do here.
Emily, we've seen, I would say, let's say over the past week or so, we've seen a rotation into more defensive areas of this market. Utility stocks, hot. Gold stocks, hot. And gold itself, silver, hot. What is your read? Do those trades stay hot after this report, or do we see a rotation into riskier areas in the market next week?
Yeah, I think those trades continue to make a lot of sense. We're also pairing more classically defensive areas of the market with quality. So we are in a very tricky part of the economic cycle. We're in this almost never-ending late cycle environment right now where economic growth is clearly decelerating, and the Fed is obviously continuing to tighten here, but the labor market is still resilient. Everybody has a job. Consumers are continuing to spend. So that means that we've got to be really thoughtful about risk management. We do see a recession likely unfolding in the back half of this year. So we want to emphasize parts of the market that can hold up well. Companies with great balance sheets, lots of cash, more durable profitability. We're de-emphasizing those sort of unprofitable growth at any price type parts of the market. We're also looking at high quality bonds as a great opportunity right now to reach for yield, generate income in a portfolio amidst a really challenging macro backdrop.
Joe, labor force participation rate came in at 62.6%. Slight move higher there. If we do see a recession in the back half of the year, where does that figure start to fall to?
All right, so we have a tight labor market. We may have a recession, but the unemployment rate during this recession is not going to look like it did during the pandemic, not going to look like it did during the great financial crisis, nor will it look like a recession in any of your lifetimes. I want to point that out. It's not going to 8%. We think it's something around 5% if we're in recession later in the half of the year. Hey, look, as we've been able to get in the data, that 3-month average annualized pace of wages is now 3.8%. If you look at weekly, it's 3.3%. That's actually a good sign if you're bullish for this market. That means the Fed really will, in a short period of time, be able to create a narrative whereby they can engage in a strategic pause. Brian, you're right. We're going to see a repricing of rate hikes. Those rate hikes, or excuse me, the rate cuts aren't going to happen this year, but maybe early next year.
Let me just hop in here, Joe, because if we get that next rate hike, like you're calling, are we again talking about a late April, early May, a revival of this banking turmoil that we saw in March?
No, I don't think 25 basis points is going to cause a revival of the banking turmoil. Look, there's 20 to 30 banks that are going to need policy attention or a private capital solution. That's already baked in the cake, right? As long as we don't have a large bank in Europe blow up, I think we're going to get through this. My personal opinion or my estimation is the worst of the panic is behind us, but banking crises are slow-moving beast and profoundly nonlinear. Brian, this is going to go on not for weeks or months, but for years. the period of the last 15 years where we really haven't had banks failed, well, that's an era that's now in the rearview mirror. Going forward, there's going to be banks who are going to fail, and they should fail. And what we want to do is put in place policies that protect depositors, not just individuals, but the small and medium-sized enterprises that are the beating heart and soul of the American economy.
Emily, how are you looking at the turmoil within the banking sector? How much of that has impacted or will impact hiring plans here moving forward?
Yeah, it looks to be isolated for now, to Joe's point, to some banks that were poorly run and ran into solvency issues, which does typically happen when the Fed raises rates, something breaks. And we saw that in the banking sector, and policymakers in Washington have put a lot of firepower behind shoring up the banks. But we do continue to see liquidity as something that's a concern for us. So we look to potentially other, kind of cracks, whether it's areas like commercial real estate or other kind of highly levered parts of the market that may see some challenges ahead. So, we do see this again as a period in which we are likely to see the impact of, or the lagged impact of Fed tightening ultimately pushing us towards a recession here. And we want to be really mindful of positioning for that. Joe mentioned things moving slowly. Right now, it feels like the things are moving slowly. We're seeing these kind of little cracks in the labor market, job openings coming down, still very elevated, but we're seeing that slow. Challenger layoffs. We're seeing that the most layoffs are up 300% over a year-over-year basis. Of course, many companies overhired, 15% month over month in terms of the rise in layoffs. So this is happening. It's happening slowly. But once we start to see corporate margins really compressed and companies are dealing with that margin pressure, they will start to lay off workers, and it may happen quickly here. So we want to be patient. Patience is a virtue.
And Emily, for investors that are perhaps not trying to fight the Fed, but anticipate the Fed, as we talk about all the time, how can they best make sure that they're curtailing QT or quantitative tightening as a headwind risk to their portfolio?
Yeah, I mean, look, the bond market is still pricing in 100 basis points of rate cuts for the remainder of this year. So we want to be mindful of that. That is reflected in the price. It's helping areas like quality growth outperform here. And we think that that's right. We think that the Fed is going to have to deal with rising unemployment. It's going to happen quickly towards the end of the year. Again, owning higher quality bonds, quality on the equity side, more defensive assets is really the name of the game today.
All right, Emily, Roland, Joe Brusuelas, as always, great to have you guys here breaking down this jobs report.